Welcome back to Ground Rules, where we look behind the price board, unpack what's moving the markets, and ask the questions: what matters most? What does it mean for the decisions you're making on the farm? The US crop tour certainly woke the markets last week, with the US maize yields looking considerably weaker than expected. Soybeans, on the other hand, are looking surprisingly good, and that leaves us with one big question. Are grain markets beginning to establish a new higher price floor, particularly for maize, or could we still see prices pull back before the next move higher? There's a lot happening beneath those headline numbers, so let's get into it. Let's start with where the markets are now trading. White maize spot prices dropped to 3,828 per ton, while the July 27 contract moved lower to 4,165 on Tuesday. Yellow maize prices also dropped, reaching 3,805, while the July 27 contract decreased to 4,042 rand per ton. Soybeans initially also moved higher but fell again a bit on Tuesday, with the spot price reaching 8,220 rand per ton, with the May 27 contract price now trading at 8,040 rand per ton. Sunflower seed dropped to 10,300 rand per ton, with the May 27 contract at 9,785 rand. Wheat spot prices increased to 6,194 rand, with the December contract price moving up to 6,158 rand on Tuesday. Elsewhere in the market, the sorghum import parity price landed in Durban, traded on 4,402 rand per ton. Argentine shelled groundnuts with the Randfontein export parity price traded on 22,238 rand, with cotton now on 11,390 rand per ton. If you were watching the markets last week, you'll know that the US crop tour had an initially big impact on dollar-denominated maize and soybean prices. That's not something we necessarily see every year from this tour. But as results started coming in, showing crops in certain areas looking 10% and even in some cases as much as 20% weaker than last year, the market started paying attention. Now, here's where we need some perspective. When those same crops were compared with the 3-year average, many were still performing better or relatively close to that average. So we're not necessarily talking about a bad US crop, with the US still expecting to produce a relatively good harvest this coming season. For me, the bigger concern is what happens to carryover stocks. In other words, the gap between how much grain is produced and how much the world continues to consume. When the final crop tour numbers came through on Friday last week, we saw a fascinating difference between maize and soybean figures. ProFarmer estimates the US maize yield at 173.2 bushels per acre. The USDA's estimate is 180.7 bushels per acre. That's a meaningful difference. If ProFarmer is closer to the final number, the US maize crop could come in considerably below what the USDA currently expects. Soybeans tell almost the opposite story. ProFarmer estimates soybean yields at 53.3 bushels per acre compared with the USDA's 52.7. So the US soybean crop still looks very good, and there remains the possibility of a very large, potentially record crop. And that's why fundamentally the story is beginning to look stronger for maize than it does for soybeans. We're already seeing that difference reflected in prices now as well. But here's the part I found particularly important. We've had some very good global crops over the past few years, and yet demand has grown so rapidly that countries such as the US and Brazil still need to produce enormous harvests just to keep global stock levels relatively stable. That's particularly important for maize. Those very high US yields that were initially expected are now looking less likely, and at the same time, we still don't know what weather conditions will look like when Brazil begins planting later this year. So, in my view, the market is starting to respond to the possibility of significantly lower carryover stocks as we move into 2027 and 2028. particularly for maize. Let's be clear, we're not expecting an immediate maize or soybean shortage in the short term, but the market is beginning to ask whether that could become a possibility next year. Europe, wars and biofuels add another layer, and then add everything else happening around the world. We're seeing production pressure in parts of Europe with extreme heat waves, geopolitical conflicts continue creating uncertainty, and global biofuel demand continues growing. Investment funds have certainly noticed, with funds and long positions in maize already climbing to more than 300,000 contracts, while soybean long positions are sitting at around 190,000 contracts. Wheat is a very different story, with fund positioning remaining considerably more negative. But has too much good news already been priced in this market? Now we need to introduce some caution. Everything we've discussed so far is certainly supportive for the maize and soybean markets, but I'm starting to become concerned about what happens if unexpected news suddenly moves in the opposite direction. Remember, global stock levels are still relatively healthy, and a significant amount of the negative supply news may already be reflected in the current price structures. That creates an interesting market dynamic. From where we're sitting today, new information may find it easier to push prices lower than to drive another equally dramatic rally upwards. For example, imagine geopolitical conflicts begin easing, Chinese purchases from the US slows down, final US yields turn out better than the crop tour suggests, or oil prices fall sharply. Any one of those developments could change sentiment, and then remember those large speculative fund positions. Funds have already built substantial long positions, and if the story changes, they could start exiting those positions very quickly, and that could put considerable short-term pressure on prices. So, what would push prices even higher? For maize and soybean prices to make another strong sustained move higher from here, the market is going to need new evidence. In the US, the key question will be whether final maize yields really do continue moving lower. Then attention shifts south. As Brazil and Argentina enter their planting and growing seasons, markets will be watching closely to see whether El Nino actually results in a drought or lower yields there. Oil is another factor. A sharp increase in crude oil prices could provide support through stronger biofuel economics. And for Chicago maize specifically, one potentially powerful catalyst would be aggressive Chinese buying of US maize specifically. That could change the market conversation very quickly. And then there's Suffolk as well. One of the most interesting local developments is that Suffolk prices have continued strengthening despite a much stronger rand, which is now trading close to or under 16 rand to the US dollar. My view is that the rand may currently carry more risk of moving back towards 16 rand 50 on new developments than simply continuing to strengthen towards 15 rand 50. If we do see that weakening, it could naturally provide additional support to Suffolk's grain prices. I don't necessarily believe prices are simply going to continue climbing in a straight line from here, as was evident on Tuesday. Instead, we may be starting to establish a higher price floor, particularly for maize. In the short term, markets could easily pull back. Funds could take profits, and new information could change sentiment. But if US maize yields continue declining while global demand remains strong, those pullbacks could also recover relatively quickly. And that brings us to what I think is the most important question for this week. It's no longer only about how high maize prices could go. Are we perhaps establishing a new higher price level as we move towards 2027? It's still too early to answer that with certainty, but the supply and demand picture is providing considerably more support than it was a few months ago. And at this stage, that fundamental story looks much stronger for maize than for soybeans. Wheat, however, is telling a slightly different story at the moment. There are some production areas where yields are creating concern, but one of the biggest drivers has been the Russia-Ukraine war and attacks targeting export ports. The issue isn't necessarily that the world suddenly has much less wheat, which is driving up prices. It's that some of those available wheat cannot easily reach international markets, and that creates an unusual risk. War is incredibly unpredictable. The conflict could ease unexpectedly, or attacks on ports could stop, and if that happened, some of the wheat currently struggling to reach export markets could quickly become available again. That uncertainty makes traders more hesitant to build aggressive long positions in this market. For me, that is limiting some of the wheat's upside potential, particularly when combined with the stronger rand that we saw over the past week or so. Sunflower remains one of the stronger oilseed markets at the moment. Locally, stocks remain relatively low despite the larger crop, while production challenges in Europe and uncertainty surrounding Black Sea exports continue, providing support, the same as for wheat. But I'd be cautious about assuming those strong prices will simply continue far into the future, into next season. If drought risk remains elevated for South Africa's next season, we could see producers planting considerably more sunflower next season. And if Russia and Ukraine also produce larger crops, the combination could bring significantly more sunflower supply into the markets. That could put prices under renewed pressure next year. So sunflower may look strong today, but today's attractive prices could itself encourage the additional production that changes tomorrow's market. AMT and ground rules, the market without language barrier. Good market intelligence should travel further than one language, and that's why AMT and ground rules are opening the same market conversation to more South African farmers. AMT continues to bring trusted agricultural market intelligence to its Afrikaans audience, while ground rules takes those insights into English, giving more growers, producers, and agribusinesses access to the numbers and the story behind them. Same market, shared insight, more farmers in the conversation. Thank you for joining us for another Ground Rules Grain Market Update. Until next time, stay informed, stay curious, and remember, the best farming decisions always start with solid ground rules.